for taking time out. Mr. Sabnavis, what is your expectation from today's figures? The industrial output figure has come in at 5%. That's compared to a Bloomberg estimate of 4.5%, while we're still awaiting figures for CPI. First thoughts on the industrial output figure and expectations from CPI.
See, for CPI, we're expecting a number of 4.9%, that is close to 5%, because nothing really has changed since last month. There's still pressure in terms of food prices, so I think that's something which is going to keep the headline number elevated. Now, in terms of the IIP, we had an expectation of a slightly higher number of 5.5% because of this particular month of April being a part of the election time. We also had the IPL going on. So there was a case of one assuming that there would be quite a bit of spending, but I think 5.5% is a very good number to have to begin the year with, given the fact that we also had the coal sector, which had shown about 6% growth in this particular month.
Got it. Mr. Indranil, coming to you, what are your expectations from the CPI figures? We're awaiting the figures still. They should be out anytime now. But we have seen inflation remain fairly range-bound in recent months, ever since the start of this year, actually. And today's figures are also unlikely to be very different from what we'd seen last month. So what is your expectation?
Madan, my expectation also is a 4.9. So there's no differentiation over there. Going forward, I think the critical elements that we need to look at, apart from the pressures that the RBI tends to talk about in terms of the food prices, the spread of the southwest monsoons remains critical. But just before this sort of interview, I was also reading a news snippet which tended to indicate that there is some sort of stalling up of the southwest monsoon at this point in time. So even though the headline IMD number is a very solid 106%, I think spatial and temporal distributions remain sort of important. I think the figures on the CPI are flashing at this point in time on the screen, which is about 475. So I hand you over to take the discussion forward.
Okay, all right. So that's the figure that's come in for CPI inflation, 4.75% for May. Now, that's compared to a figure of 4.83% in the previous month. That was for April. So not too far, but still a little bit of an easing from what we saw in previous months. Now, Madan sir, again coming back to you, your quick thoughts on the headline. Like you said, it's not, it's not too far from what you were expecting. Before we get into the breakup, any thoughts on the headline figure?
So I think this headline number will remain at this particular, this is the last time when I'm going to have a slightly higher number. From July, August, September onwards, rather from June will also probably be high. July, August, September, we could be expecting the numbers to be more benign because of the high base effect. So as of now, I think the concern which we are seeing in the month of June is that prices of onions have also started going up. Potatoes were up in the earlier months. So I think the pressure of vegetable inflation, pulses inflation is something which is going to prevail for a longer period of time. And if you're talking of the pure kharif crops like pulses, which have witnessed substantial increase in prices, I think the pressure is going to remain in absolute terms. The prices are going to remain high and elevated. Though in terms of the rate of change of prices, that is inflation, there could be some kind of cooling down of those numbers. So I think the second quarter is going to have more benign numbers compared to the first quarter. And that's exactly what also the RBI's forecasts of inflation do indicate for the next quarter.
Before we proceed further, let's take a minute to go through the breakup for the inflation figures. So we've seen cereals and products come in at 8.7%. We're also seeing meat and fish as well as eggs both come in above 7%. Milk and products are at 2.6%. Oils and fats have continued to contract. And there we're seeing deflation of 6.7%. Important Importantly, vegetables inflation has come in at 27.3%. Pulses and products inflation has come in at 17.1%, which overall brings food and beverage inflation to 7.9%. Again, not very different from the figure we've seen in the previous month. Clothing and footwear inflation continues to remain benign. That's come in at 2.7%. Housing has come in at 2.6%. Fuel and light inflation, again, we continue to see deflation there. It's contracted by 3.8%. And that's some of the key constituents of inflation. Like you've noticed, the trend is not very dissimilar to what we've been seeing through most of the year. Food and beverage inflation continues to remain slightly elevated, while core inflation that excludes food and fuel continues to remain benign. Mr. Indraneel, coming to you, what is your takeaway from the breakup? Food inflation continues to remain elevated. You've also spoken about the southwest monsoons. We did see timely onset of the southwest monsoons, but we're still waiting for how the monsoons pan out over the next few months, which means that food inflation is something that the central bank also understandably so remains cautious on. What are your thoughts, sir?
No, absolutely. I think food inflation is something that the Reserve Bank continues to look at, and especially in the summer months when we have a history of sort of seasonal upswing in terms of both the vegetables and pulses. Now, just to sort of quote the actual numbers, at least till the first 11 days of June that we have data, the vegetable segment has actually led by, once again, tomato has actually moved higher by around 14.7% month on month for the month to date. And this is relatively higher than the previous month when it was at a 6.3%. Now, given that, we expect the pressure from the food items to continue into through June. The July is something that we will be watching out for in a very significant way. And this year may actually be quite important from the vegetable perspective and the perishables perspective, simply because of the significant heat waves that we saw across the country. So yes, food remains an element in terms of tracking for the Reserve Bank of India. And even though the food prices may not directly be controlled by rates, the reason why the RBI would want to track it is food continues to be a very significant piece within the overall CPI. And to that extent, the inflation expectations can alter quite significantly, and that might actually lead to unhinging of inflation expectations, which any central bank would sort of want to prevent. And therefore, food continues to be a significant watch for the Reserve Bank in months ahead.
Got it. Okay. And coming to you, Madan sir, so, again, going forward, like, food inflation, like Mr. Indraneel also pointed, is something that the RBI too is on wait and watch mode regarding, given the number of factors around it. But would you expect to continue to see supply side interventions in terms of cereals and pulses? In case of vegetables, of course, from what I've understood, so far we haven't seen any bump up in prices because of the heat waves that we saw in April as well as May. But is that also something that we're watching out for, possible effects of the heat wave in case of vegetables? Given that so far we've not seen any impact on prices, is there still a chance that going forward that might actually change?
No, I think we're already seeing it. As I mentioned earlier, we have seen the prices of onions have suddenly started moving up. We had tomato and potato, which were already concerns in the last couple of months. And what we have seen is on account of the heat wave, there is a case of saying that all the green vegetables production output gets affected. And given the fact that their transportation costs also to be added, the prices do tend to increase. So today, if you go and do your vegetable shopping, you're more likely to be paying higher prices in absolute terms. I'm not talking of the inflation numbers because the base effects actually come into picture, which could be distorting the reality. But prices are definitely moving in the upward direction. That's something which is going to continue. Now, in terms of government intervention, we have seen that normally the intervention has been in the form of the government has been intervening more for rice and wheat rather than for any other commodities. And this is something, I think the wheat crop procurement hasn't been optimal this year. So there could be a case of saying that there could be certain supplies which will have to come in the open markets on the side of wheat. But that will be a problem which we'll face during the second part of the year, not actually the first part of the year. In terms of rice, yes, it was a good crop last year. We had maintained the output level in 23-24 to the 22-23 levels. But as we approach the beginning of the monsoon, the sowing part of rice, I think the government will be taking a closer look at it, because any kind of delay in terms of sowing is something which could mean that there could be a delayed harvest, in which case the government will have to be ready to intervene in terms of augmenting supplies if that needs to be done. This said, I think the fact that we have fairly comfortable stocks of rice and wheat should not really be an issue. To be more of an administrative issue rather than a supply constraint. But when it comes to the other crops, pulses in particular, I think that is where there should be major concern, because we have something like tur and urad moong, which are harvested once a year, and the crop is made available for the rest of the 365 days. And the harvest normally takes place in the months of October, November. So I think that is something which could have an inflation potential, of course, given the fact that the base effect is there. High inflation the last year could lead to lower numbers in the next year. But we should always be looking at absolute prices, the actual supplies which are coming into the market, because that would also determine whether the government would have to take some kind of action for imports, something which it did last year to assuage prices.
Okay, all right. And Mr. Indranil, coming back to you. So, we've been talking about how we do expect some more easing going forward in the Q2. But given most estimates, including the central banks, we are expecting a little bit of a bump up once again in inflation figures. And is that purely base effect led, or is there more to it? And I also do specifically want to ask you about core inflation, actually. We have seen core inflation hit record lows in the ongoing inflation series. But is that a trend that's expected to see a reversal going forward?
Well, I think you did mention about the base effect, and the low numbers for the Q2 would definitely be due to the base effect, and that is more from the vegetable side and the food side. In terms of the core, I think what needs to be clearly understood is some of the surveys that the RBI had been doing in terms of the price pressures. It seems that services sector farms are likely to be sort of passing on the higher input cost to the end users. The global commodity prices continue to be on the higher side, and we have also started seeing some amount of depreciation pressure coming across in terms of the currency markets. So all taken together, we should sort of expect the core inflation to reverse soon. In terms of my own model estimates, I think core inflation is going back towards the 4.2, 4.3 levels by the end of March of the current financial year, from the current 3.3% approximately. I don't really have the core figure for this reading immediately with me, but definitely from whatever the current reading is, we see a core sort of moving towards the higher side. I think the critical issue, of course, is in terms of the growth inflation mix, with growth remaining relatively stable and also sort of tilting towards the higher side. There could be some amount of easiness with which the manufacturing sector can pass on higher input costs to the end users, and that's the reason why we are expecting the core trend to reverse from here on in the months ahead.
Okay, all right. Now, before we can shift focus to IIP, Madan sir, coming to the RBI policy, today's figure does not change anything at all, broadly along expected lines. What is the outlook for monetary policy, and when does the Bank of Baroda actually forecast a rate cut, be it October, or is it in the December policy? Or
I think the earliest that we could expect... Yeah, I think the earliest we could expect a rate cut would be October. The reason being that, going by the RBI's forecast, inflation is going to come below 4% in the second quarter. However, in the third and fourth quarter, we're going back towards a 4.5% range. And that is something which the RBI has already flagged, which means that the comfort level would really come once we actually go below that 4% mark. Then depending upon how the monsoon is faring, how it has spread, whether there are any pressures which are likely to occur from certain specific crops which have high inflation potential, the RBI could actually take a better view, because I think it has been mentioned indirectly also by the RBI that they wouldn't like to take a decision at a point of time which may have to be reversed. And given the fact that, as Indranil said, growth seems to be very much stable in the upward direction, there's no need for one to go ahead to say that, look, I want to protect growth, I'll do everything to protect growth. Growth is going on the right path. And we have to be very nuanced when it comes to reduction of the repo rate. In fact, I would believe that you will have to probably change the stance first to ready the market for a cut in the rate, and then you probably do it. Otherwise, there will be this acceleration of expectations in the market, which could be making things a bit chaotic. So I think October could be the time where there could be some review taken in a serious manner once you have gauged how exactly the monsoon is behaving, and also what exactly is the inflation trajectory. Because mind you that today we have seen prices of onions, potatoes, tomatoes going up. They really have the potential to also skew the 3.8% number in Q2. Things could get nastier in case there are problems of short of supply, which could be spiking the prices even further.
Okay, all right. Coming back to you, Mr. Indranil. So let's have a look at some of the industrial output figures. We've seen mining come in at 6.7%, manufacturing at 3.9%, and electricity has grown at 10.2%. Is the figure for manufacturing a little bit of a concern?
It's very difficult to comment on the industrial production number sort of on a going basis, because there are so many sort of fluctuations that happen within the industry. Anyways, I think the overall, from a production perspective, we should be expecting some amount of tapering off of the manufacturing production. I'm not really talking about this data perspective, because there could be some amount of base effect also in this data. But going forward, I think the expectation should be that production to a certain extent will come down. Because we are expecting the pass-through in terms of the rate cycle of the RBI, which is still not complete, will continue, and relatively higher price pressures will also mute the demand. The critical element that we possibly need to look into so far as the production side is concerned is what is the extent to which rural demand cranks up. We have been expecting that the rural demand will be moving on the higher side. Most of the push in terms of the demand side story has been from the urban side, and that too discretionary urban demand. And it is very essential for the rural demand to actually move up. The broad expectations are that if the monsoons are good, and if the income generation for the rural sector is relatively healthy, because of the good monsoons, we should see some of rural demand reviving. It's a story that will possibly play out in the current quarter and the quarter hence, and as per the sort of spread and the reach of the southwest monsoons, so to say. So that's something that we need to sort of track. I think electricity to a certain extent maybe because of the very significant demand due to the heat waves, that could also have been a reason why electricity production has been on the higher side, even though manufacturing may have been relatively muted.
Okay, all right. Coming to you, Madan sir, again regarding the IIP figures, especially on today's manufacturing print. You know, and also about the headline print, we have seen, industrial output growth also remain fairly range bound, and today's figures are fairly in line with some of the previous prints we've seen. Structurally, do you think that, these figures are not particularly comforting, especially today's manufacturing print? And also, I do want to get into the breakup as well. So consumer durables, for instance, has grown by 9.8%, whereas consumer non-durables has degrown by 2.4%. So my second part to my question is is that cognizant of what we're seeing in terms of consumption trends and demand as well?
Yeah, I think you've given the answer out there, because whatever we are seeing in the manufacturing sector is dependent a lot upon what happens to consumption and investment. So today, when we are saying that there's a problem of consumption in the sense that it's not growing at a desirable rate, because if you see, for example, in last year, if you look at the difference between growth in consumption in nominal and real terms, it's a stark difference which is there, primarily because of the inflation factor. So I think consumption is something which has been lagging in the last couple of years, and that's something which needs to revive. That's only when we'll see sustained growth in the IIP, especially of the consumer goods segment. And the second part is in terms of investment, where we have seen that sectors like iron and steel, cement, they're the ones who are doing relatively better because of the government focus on infrastructure, which includes both roads as well as housing. So these are the factors which have been driving it. And it's also true that if you look at the overall IIP growth numbers, we are no longer in that particular range of 8 to 9%, which we saw in the last decade. So there's obviously a lot of distance which has to be covered. One is hopeful that as consumption and investment revive in the current financial year, this is, of course, kind of a rolling expectation. It didn't happen last year to the extent we expected. So we expect things to be more normal this year. So even kind of a marginal improvement in consumption as well as private sector investment, I think that is something which can actually push this particular number up. So in fact, we at Bank of Baroda, we have an estimate of 7.3, 7.4% growth in GDP. It is premised on the fact that we see revival in the manufacturing sector. So we're actually looking at manufacturing sector playing a more dominant role in terms of this GDP number compared to the services. And of course, in terms of a single month number, I think we should be a bit cautious in terms of interpretation, because extrapolating 1 month, that is the month of April, which of course is a busy season for India in terms of the time when the rural income is spent. The marriage is also held in the month of April and May. So I believe there should be some kind of a bump up in demand, but that it may be incorrect to extrapolate it either positively or negatively for the rest of the months. I think we'll have to wait for probably 3 months to get a better picture about whether there is any turnaround in both consumption and investment.
Okay, yeah, no, fair enough. Mr. Pan, coming to you, what is the scenario looking like in terms of other high-frequency indicators? For the most part, for the data that we do have for the ongoing fiscal year, most high-frequency indicators appear to have held up. And at this point, would it be safe to say that economic growth momentum continues to remain intact?
So yes, I think what I would call the Indian economy today is a golden Goldilocks, not even only a Goldilocks, because every macro parameter is looking to be on the direction that any sort of authority, be it at the fiscal level or the monetary level, would be desiring. The fiscal containment is continuing, and we expect that the containment will continue going forward, given also the bumper dividends from the Reserve Bank of India. There are tentative signs of a rural pickup in terms of the two-wheelers, even though the tractor sales seem to be relatively on the muted side. The PMIs are doing relatively better. Inflation growth mix, with growth holding up, there is not really too much of a pressure from the inflation side that is coming on, which is also providing this quote-unquote elbow room to the Reserve Bank of India to hold on to the rates where they are. So yes, overall, the macro scenario for India is relatively looking better. And most of the sort of forecast models that we run do not really show any stress in terms of the macro variables, and the banking sector strength also is quite evident in terms of the low GNPA and NNPA ratios, and in the most severe sort of stress testing condition by the Reserve Bank of India, the capital doesn't get dented at all. So having said that, I think to a certain extent, my personal feeling is that given the gross savings being relatively okay, your net savings actually is coming down, which necessarily means that there could be continuing to be a lot of stress or a lot of push that needs to continue from the fiscal side in terms of the infrastructure spending. The private infrastructure spending hasn't really come up the same way we would expect economic models to behave in terms of the crowding in, and I think the haziness or the visibility of demand, both domestic and global, is a factor that is holding back private investments to a certain extent. So overall, we have a relatively good macro. So it's to a certain extent, I think the condition today is a good macro, but there could be some sort of question marks in terms of the micro aspects of the economy, in terms of segments of the economy that are performing well and segments which are not performing. So it's a two-engine economy that we see. Unemployment relatively is relatively on the higher side. That's another worry for the economy. And these are some of the issues that we would possibly continue to look at in the fiscal year ahead.
Okay, all right. And with that, we're completely out of time. Thank you so much, Mr. Sabnavis and Mr. Pan, for taking time out for this conversation. So that was the discussion around today's recently released inflation figures. The headline figure has, of course, come in at 4.75%, and that is encouraging because it is a tad lower than what we'd seen the previous month. However, food inflation and the concerns around food inflation remain. Food inflation continues to remain elevated, and that's coming at 7.9%, with vegetables inflation having come in at 27.3%. Thank you so much for taking time out and watching.